Welcome to the daily update, where I'll go over the action in the market for Monday, January 6th, and we'll see how things look for Tuesday, January 7th. Had a nice little bounce. We're still looking negative in the short term. We're positive in the intermediate term in that we're back above the 50-day moving average, but we're not seeing all that much improvement under the surface with the market. A lot of it is the mega caps and the semiconductors, which does help the market, and that's why the index goes higher. We started off really positive, and it looked like we were just going to really shoot up. Well, as the day went on, we gave up a lot of those gains. And if you look at just the chart by itself, and I'll show you that in just a moment, it's not all that positive of a looking day, but we did close up. There's some improvements that are coming into the market. So we'll just see day by day as things unfold if we're switching back and looking more positive, if we're going to be in a more mixed environment, or if we're looking more negative. Let's go back and look at what happened, and then I'll go through some charts. Right at the open, we had a gap higher open. Europe was strong. That carried over into the S&P futures, and so stocks in the US ended up gapping higher. We got above R2 immediately at 59.88. Then we started dealing with that 6,000 level, but then we topped out at about 6,020, which really was the upper end of the 20 period moving averages. And I'll show you a chart. It's a moving average of the 20 period high, and we seem to top out at just that point. Then we started to decline. We went back below R2. We found support at R1, so we're back under 6,000. Then we got down to 59.65 and we closed above R1. We were up well over 1% at one point, and we gave back about half of those gains. Ended up closing up 0.55%, and volume is picking up, so we're back to above average with that. We are still negative in the short term. We're turning more positive in the intermediate term, but there's still some things that aren't looking really good. We're still positive in the long term. Interest rates continue to go up. And even with the market bouncing up in Friday session and Monday session, interest rates continue to go up. And at some point, the market's probably going to notice that. If they start coming down, that could help stocks go up. But if they continue to go up, that could really pressure stocks. And also, we're keeping an eye on the different geopolitical things. We are going to get the meeting minutes from the Fed in Wednesday session. The market will be closed on Thursday for the state funeral for President Carter. And then the Prime Minister of Canada stepped down, Trudeau. So that's one of the geopolitical things happening there. Okay, some comments. It was a mixed day. We had the Dow down and small caps were down. And a lot of the solid gains that we saw earlier on, those were surrendered as we floated throughout the day. And as I said, the Dow and the small caps ended up being negative on the day. The S&P did regain its 50-day simple moving average at 59.48, but it's still under the 20-period simple moving average, but above the exponential moving average. We're right in between with these two different moving averages, but there's another chart that I'll show in just a moment. Interest rates are still going up. Mega caps and semis. Now that is healthy, and that helps the S&P 500 when they outperform. We still have a confirmed Hindenburg Allman. And in the short term, we are improving with the slope excuse me, with the slope oscillator. It's still extreme, but it's starting to turn back up. We're also showing some improvement with the PMO studies, but still extreme negative there. No change to the scenario. The Fed cut rates at their last meeting. We're going to get the meeting minutes on Wednesday. They are probably going to stop raising rates until things prove otherwise, and they've increased their inflation outlook. The dollar was down. That helped stocks a bit, but interest rates were up. Now, not by very much, but still we're up at 4.61%, where after Friday we were at 4.6%. Sentiment is still negative. Now it is improving. We got down to that 26 level. We climbed up to 32 after Friday. We're up to 37. So the context is showing that things are improving there. but we're still negative with our trend. The ADX is now weakening. It's falling below the moving average, but it's still above 20. Now, this falling below could mean that a shift could happen. We're still negative since the red line is on top and the green line's on bottom. If we are shifting back over and looking more positive, we could turn over into a positive trend, but that hasn't happened yet. We can just watch for that and see how things develop. With the update, we're positive, and now I've switched our momentum mix to positive because there's still a lot of under the surface lack of strength that's going on right now. But price is the ultimate indicator, and so we have to follow that. All right, the reports that came out, factory orders were down 0.4% month over month, a little bit more than the 0.3% they had expected. Last time they were up 0.5%. When you take out transportation, we were up 0.2%, the same as last time. Shipments of manufactured goods up 0.1%. Last time they were down 0.2%. The S&P Global US Services PMI, the takeaway from this is that we're above 50. Now, it was weaker than expected. They thought it would come in at 58.5. It came in at 56.8. And that was from the preliminary reading to the final reading. And then the previous final reading was 56.1. So we actually improved from 56.1 up to 56.8, but not as good as the previous reading that we thought we were going to get. Here is some charts. Factory orders dropping down on a year-over-year basis, actually going negative again, but we've been chopping around now for quite some time. Then we look at the durable goods orders on a year-over-year basis, also declining. This is showing some economic weakness here. Non-durable goods orders are a little bit above zero. Non-defense capital goods, you take out aircraft year-over-year, dropping to below zero. Then looking at some Isnl net blog charts here, solid returns are normal after a 20% gain. We did have a really good year in 2024, which followed a good year in 2023. So we look at the average return, it's 9.5%. And then after a 20% gain, we get 10.6%. After back-to-back 20% gains, which is what we had, we often see a 20% gain there. So strength ends up building into strength. So here's one data point that could suggest that maybe we could have a good third year after all. But there's other things to be concerned about as well. Then looking, gold is expensive relative to oil. In the intermarket analysis charts that I go over in the weekend video, I show a variation of this, but it just means that gold is really, it's outperforming oil right now. And so this ratio is really going up. And then also, this is getting to a pretty high reading down here. We just keep an eye on this because it's one of the markets that can have an impact on stocks. Sector fund flows, seeing money coming out of tech, but that's still where most of the money is going into. And then these are the different kinds of bonds. We're seeing a lot of money going back into money markets as the stock has been under pressure lately. And these just break out the different kinds of bonds that folks get into and whether money's coming in or out over the most recent periods. Average cumulative returns, yeah, over 5 years. If you invest on any given day, you tend to not perform quite as well as if you invest when we're already hitting a high. So strength built into strength is kind of the takeaway from this chart. And they're really having a lot of issues in China right now, economically, and their currency is really dropping. They're really dropping down their interest rates. They're trying to stimulate growth there. And their GDP, it's kind of holding up right now, but it has really been coming down. And so we're just kind of keeping an eye on that because there are a lot of S&P 500 companies that do business with China, and that can bleed over since nothing exists in a vacuum, especially an economy as big as China's. Then Goldman and Bank of America see gold rising, of course. Yeah, just kind of going up here. And then these are the consensus earnings revisions. They're actually coming down a little bit, and this is possibly pressuring some of the stock prices as analysts comes out and they say, well, we're lowering our forecast for the Magnificent Seven. Still really strong. It's pretty much flat to slightly declining with the S&P 500, and then you take out the other stocks after the Magnificent Seven, we're actually seeing a bit more of a revision to the downside. And this is ultimately what drives stock prices. And so when we see these coming down, that's why we've been seeing some pressure. One of the reasons. And then the valuation paradigm, this is a blended 12-month forward PE. I'm not sure what they use to blend it with, but it's just showing that we're up above that 20 level with the PE ratio. We're getting up close to 22. This also suggests on a forward-looking basis, the market is considered expensive. I did find a few interesting charts here. This is Martin Pring. I put his tweet over here in the box. I'm not sure if that's hard to read or not. Um, but this is his global financial velocity. And this goes back, all the way to the year 2000. And I don't know how this chart is actually composed. It would be nice to try to replicate something like this. It's pretty long term here. But this he bases this around the MSCI World Stock ETF, which I look at over in the weekend videos, and how it's been doing. And then the global financial velocity, where we were really coming up here, and then in 2020 and then 2021, and then we went into 2022. We've been coming back up, and now we're starting to roll back over. Now we'll have to see, is this really going to matter, or are we going to be able to turn back up from this? But this is longer term and could end up being an issue for the markets. It says our global financial velocity indicator combines the momentum of global stocks, bonds, and commodities into one series. So it's taking all of these financial assets together. The lines show equities are vulnerable when this indicator it turns down. With so many bulls going into 2025, the recent drop could be problematic. So we'll just have to see how this ends up playing out here. Then another thing, look, and I've been really focusing on the semiconductors now, and this is a chart, of course, never mind how they were not all that close to each other here, but this is something that I find interesting, but I do not base decisions around this. When you take a current chart and try to match it up with what has already happened, yeah, there are times when markets tend to act the same, but they never quite exactly line up with each other. But it can be used as a useful tool. And of course, they're going from 1995 up to 2001, which was the dot-com boom and bust. But the earnings are there now where they weren't there at that time. And so if we follow what happened after that, semiconductors could have some problems. And this is one of the reasons I'm really keeping an eye on this. We had a good day in Monday's session and things are looking a little better, but and there'll come a time when I don't focus on semiconductors as much, but right now they seem to be telling us a pretty good story. Okay, then this. I'm very bullish on 2025, probably the best year that we will have in decades. This could be the kiss of death. Okay, Jim Cramer, he's a rodeo clown, a complete bozo, totally for entertainment purposes anyway. His track record is abysmal, and you're better off using him as a contrarian indicator. That's just my opinion. I don't watch him. I read a few of his books and used to watch him maybe 20 years ago, and it was so I don't know, so entertainment focused. Let's put it that way. I don't even pay attention. All right, and then this is a chart that I thought was kind of interesting. Stock shine when sector strength is all or nothing. Well, we're coming down. There's 11 sectors that make up the S&P 500, and how are they doing? Now, this is measured by whether they're above their 200-day moving average. And when all 11 are above their 200-day moving average, we get a very high reading. When they're all below it, a lot of times that marks a bottom in the market. Well, now we're kind of coming down. We're seeing 7 right now. So we'll keep an eye on these areas, and it has been dropping off after getting consistent high readings for quite some time. Then tariffs on U.S. imports. A lot of folks are trying to project, okay, what's going to happen when the new administration comes in? There's been all this tariff talk. Is that going to be a good thing, a bad thing? So here's a chart going back and what the tariffs were during those times. Of course, the 1930s, yeah, nothing went wrong then. We only had a thing called the Great Depression. And then things really dropped off as World War II came along. And then we kind of settled out here in the 50s, and then they rose up a little bit back in the 60s, another little incident called the Vietnam War, and then really dropped off in the 70s, 80s, 90s, and then starting to go back up again here. And then they're proposing these as being very high. And this is a debatable issue going back and forth. Some folks think this is good. Some folks think this will be a very negative thing, that it's going to be inflationary, that it's not going to be inflationary. So we'll just keep an eye on it and see how it plays out. All right, here's an intraday chart. Nice, strong open. We never, R3 was up here somewhere, so we never got to that level. We did open up above R1. We quickly got up above R2. We hit some resistance and just kind of topped out here. And then we just spent the rest of the day drifting down. So you look at this all by itself. Here's the open. Here's the close. We actually closed lower than the open, and then we gave a lot of this back. This is not all that positive looking. I mean, when you're in here, you're like, oh, baby, maybe I should get in there. Maybe something should happen. I should do some buying. Then as the day went on, it just started to fizzle out and then end up coming down. And we closed above R1, but well off of the highs and lower than the open. All right. So, and now this is a little bit bigger picture. This is a little bit more positive. If you go down here to this bottom, set here last week, we've been looking pretty solid across the board, but now we're pulling back at this point. That's why I include many days in these charts, because sometimes we can get some perspective by looking at things longer than just the actual trading day here. But we were pretty much flat when the futures opened. And then when Europe opened, they were strong, and that's when we saw everything really kicking into gear, which fed over into the cash session. We hit the top and then ended up coming down. We're down slightly. I checked the futures right before I started recording. We'll have to see. And at the time I'm recording, Europe's not open yet, so we'll see if that ends up meaning anything there. This is still looking positive with the green line, excuse me, green. I do know my colors. The blue line is above the red line. So growth outperformed value intraday, and it has been, and it's showing some improvement now. And this is also showing some improvement. S&P growth of value intraday. We hit that bottom in November. We were coming up, then we were going sideways. Now we're possibly showing some improvement here. End of day growth was up really solid, 1.74%. Value was up too, but almost a percent less. And mid cap growth did quite well, as did small cap growth. And that's the wrong chart. Okay, sorry about that. This was Friday's session. This is Monday's session, where growth was up and value was little changed. And then growth, mid cap growth was up, but barely more. And the small caps were actually down. So, yeah, there you can compare Friday to Monday. Oops. All right, so our small cap growth to value ratio is back to improving after it had been pulling off. Not really doing much here with the index, though, but this at some point might help the index to go higher. It just hasn't done that yet. And we're seeing kind of that same thing. And even with the mid caps, they were a lot higher, ended up closing down pretty much at their low. But the growth to value ratio continues to improve, and not a big move up here. But we have been holding up better with S&P growth to value and going back up, but not to this previous high when we compare the growth ETF to the value ETF. But this is still looking pretty solid. And the discretionary to staples ratio, we had staples down and discretionary was up, crossing back above its 50-day moving average here. So this ratio is still looking pretty healthy. Now, under the surface, these are some good signs. We need to see other under the surface signs confirm that, other than just the large caps, which continue to do well, coming down to the 50-day moving average and bouncing up off of that. So this is still holding up quite well. It's the large caps where we're getting the strength from right now, but we're still negative with our trend. Now, we saw the red line come down and the green line go up, even though the red line's on top. But this was enough of a shift to roll the ADX back below its moving average. It's still above 20, so we're still trending, but it's a weakening trend now that is negative and also rolling over and starting to drop below the moving average in the short term, with the red line coming down and the green line going up, but still above 20. So we're still trending in the short and intermediate term, and based on the ADX, both those time frames are still negative, but possibly improving. Volume did pick up. We were actually above average, but this is an oscillator, so it's going to take a while for it tracks the last number of days together. And so it is turning up a bit. And then this is a weekly chart where we look at sentiment. We're getting more into neutral now at 58.28. And then the insider transaction ratio, also neutral at this time. And when I show this chart, then we use the insider buying ETF coming down to its 200-day moving average and bouncing up off of that, but pretty much going sideways now. The Ulcer Index is still giving us a high reading, another sentiment gauge, coming down just a little bit. Not much of a change here with the VIX, both with the line chart and the bar chart. And the VIX of the VIX actually ticked up just a little bit, but we're still below the moving averages. The skew index is continuing to decline, but we're still in this red area. The market is still expecting some kind of a big move that hasn't happened yet. And the momentum for the VIX actually is now starting to turn back down. We had been going up with the VIX, which was turning the momentum up. Now, over the last few sessions, it's starting to come back down again. And we're seeing a contradiction here. This fear gauge is going up while this other fear gauge is going down. Seeing a little bit of an improvement with the risk on to risk off ratio as the big stocks, the high beta stocks, outperformed in Monday's session. Really dropped off here with the equity put call ratio on the daily chart. So we're going back down with the 5-day chart, and we're getting quite a low reading here. When we look at the longer term chart, we're also coming back down now with the 10-day, and that's more positive for stocks. When that means folks are taking off hedging, they're getting rid of their puts that they used to hedge with, and they're anticipating that the market's going to continue to go up. And volatility risk premium is also dropping off underneath the band, not suggesting a lot of risk heading out 30 days. And seeing some improvement here, but not all that much with the advanced decline ratio based on price, just kind of sideways. A little bit of a tick up here based on volume. Longer term, we're positive since we're above the moving averages, but not as much of a bounce back up is what you would think. This is one internal measure. We are seeing a little bit of an improvement here, a bit of an expansion of the new highs, but also we're seeing a drop off, but still an expansion of new lows as well. However, the 5-day is starting to turn back up, and we're starting to turn up with the 10-day. If this could actually sustain an uptrend with both of these moving average based measurements, and this could show a lot more green than red, that would really help the internal structure of the market. We're negative but improving here with our advanced decline ratio, both in the short and intermediate term. So we're coming back up, but still below zero based on price, showing a little more improvement based on volume, but still negative. And this is kind of hard to pick up here. It looks like we declined with the accumulation distribution, but the boom indicator has us actually improving. This is pretty much on its moving average. We're not seeing much conviction right now. And we're still negative with the Chaikin money flow. Even though the histogram bounced up, the red line is still continuing to go down, and we're still getting a negative reading. And we actually turned down with the Chaikin oscillator. So we're getting a real mixed picture with our smart money indicators. The vortex is negative, but the red line's coming down as the green line's coming up. Not much of a change here with the cumulative advanced decline line based on price. A little bit better advance here based on volume. This is still improving, but not as much as you might think. We actually crossed above zero after Friday, and we're going up, but not with any real enthusiasm after Monday, with our 10-day simple moving average of the advancers minus the decliners. And a little bit of a tick up here, but still negative with the 10-day average of the highs and lows for the S&P. We actually ticked down a bit with the NYSE advanced decline line, where the S&P ended up going up. So we're seeing a bit of more of a disconnect here. And then looking at the cumulative advanced decline line for the NYSE, that's still looking better. And we're turning back up, but below the moving average with the regular NYSE advanced decline line, and also below the moving average with this other NYSE advanced decline line. And we break it out based on common stock, based on price. Not really doing all that well. Actually down a little bit here. And volume, though, did go up. So volume is tending to lead price a little bit there, possibly. And not much of an improvement with our advanced decline line. We're still going down. With the up day that we saw, common stock down, S&P down, flat with the mid caps and declining with the small caps. Not what you would expect to see if it was a really solid day. Improving here, though, the 5 day moving average of the highs and lows across the broad market, still negative, but coming back up after getting uh, quite a bit stronger negative reading. Showing a little bit of an improvement here, but no real solid thrust with those stocks in the S&P above their 20-period moving averages. So we're still bouncing up here. We want to get up to this 70 level fairly quickly to show good upward momentum. So it's improving, but not really strong, at least at this point. And we actually ticked down with those stocks above their 50-day moving average. We went down with the 100-period moving average study and the 200. Okay, if this was such a solid day, these moving averages would be going back up, not going down. Short term, we're back above the 50-day moving average, and that's positive. And that's why I've switched our outlook to the intermediate term back to positive, and we are picking up with volume here down below. And going up a little bit with the 20 period, we were flat with the 50 period and flat to even declining a little bit with the 200 period moving average study on the S&P itself. Crossing back above the midpoint with the Stochk RSI, so that's turning more positive. Also above the midpoint with the Williams percent R, turning back a little more positive. We're going above the midpoint with the CCI 14, and we're just under the midpoint with the CCI 20. So these are showing signs of improvement. Coming back up with the short-term stochastic, that's looking better. Turning back up with the intermediate term, we're still declining with the long-term stochastic. And the force index is looking a little more positive there. So there are some real signs of improvement. And we're getting back above the green line and the blue line here. If we can stay above that and see the lines continue to go back up, that would help the short-term trend to improve. And as I said, we're below the simple moving average. We're above the exponential moving average. So we need to clear this and get above it and see the lines start to turn back up. And we're above the midpoint with our standard deviations chart. Intermediate term, we're right at 0 with the balance of power. So that's neutral right now, but improving. Still negative with the go, no go, with the brown bars. Getting above the midpoint with the highest high, lowest low value chart. Seeing a bit of improvement with the TTM squeeze, lighter shade of red and going back up. Coming down with the standard deviation. This measures speed, and we've been, going down, going up, going down, going up. And as these last 10 periods are calculated, this is likely to continue to drop off. Improving, but still negative with the ease of movement. No change with the Arun indicator and still negative. No change here with the S&P McClellan oscillator. We were flat and we're still below 0. So we continue to decline based on price, but we are going up based on volume. That could be under the surface positive if this is one of those instances when volume leads price. It actually came down with the NYSE McClellan oscillator. It was a little bit more positive after Friday since it crossed above 0. It ticked down a notch here on Monday. But we're still above 0. So we're going up barely with the summation index based on price and volume. Turning back up, but still below 0 with the Swenlin trading oscillator. So this is showing a little bit of an improvement here. Momentum is still negative, but trying to improve with the PMO. And then based on price and volume. And kind of ticking down a little bit with those PMOs that are rising. The buy signals are right on the border of being extreme. 20 is the level, and that's the reading we're getting here. But seeing a bit of an improvement with the buy signals, we're flattening after we had been declining with the PMOs above 0. Turning back up with the slope oscillator, still below this red line, so that's why we're extreme negative, but this is improving. MACD ticking up a little bit, but it's still negative. So in the short term, we're seeing an improvement here with the slope. Not as much strength here with the TSI, turning back up with the intermediate term oscillators, but we're still declining with our longer term oscillators. The Copic curve is turning up, it's still negative there. Coming back up into this green area, which is more positive for the Sean trend meter, crossing back above 50 with the money flow, and we declined with the ultimate oscillator below 50. Coming back up with unbalanced volume, still above the moving average, crossing just a little bit above 50 with the RSI 14 and the RSI 9. So the momentum is starting to look a little better according to the RSI. But when we look at the intermediate term trend based on 50 periods, we're still under the blue line and the red line, even though we're back above both the simple and exponential moving averages here. That's why we're switching back more to a positive look. Can we hold out? But this bar just doesn't look very good. Here's the open, the high, and then we came down, and then the close. The bar itself is not all that good looking. The context is we came down here, we actually took out this previous low, which could be end up being negative, but so far we had two good days after that. Now we're seeing, can we break out above this really short-term line here and set a higher high with this? And so we're above the 50 period moving averages, right in between the two 20 period moving averages. And we're positive with the Elder's Impulse system for the S&P, but we're still negative with the parabolic SAR. Seeing an improvement here, the bullish percent index. This is encouraging. We're going back up. We're above the moving average. So we could actually take this as positive for the time being, although we are still below 50. So technically we're negative, but we look at more the direction. And ticking back up with the NYSE bullish percent index and actually showing quite some strength here with the NASDAQ 100 bullish percent BPI crossing back above 50. And this is why the mega caps are really leading things right now. This is the resistance that I was pointing to because whenever we stop at a point and it's not at a pivot point on an intraday chart, I start looking for something else. And this was the 20 period simple moving average of the high. And that was the high that we set in Monday's session. And then we came down off of that. Now we need to clear this rainbow, this little mini rainbow, to have these lines turn back up and look more positive. And so far, we haven't done that. We're right inside the rainbow, mini rainbow, coming back up out of the cloud, but we still see where the blue line is below the red line. That's negative, but we are coming up here with the green line. That's very hard to see. And this might be explain some of the longer term overhead resistance. This is a trend channel going back to 2009. We hit this upper end of the trend channel, and we've been having a hard time getting back above that, at least in the time being. So we are looking more positive with the hike in ASHI, trending basis there. We're negative but pointing up with the Kegi chart. We're still negative with the Renko chart, and we're still negative with the three-line break. So we really didn't see any conformity there, any confirmation of things. We did get some new X's drawn in here with the point and figure chart with the upward move that we saw, even though we closed well off of the highs. But there's no signal that's being generated currently. Then long term, actually coming down a little bit with the 150 and 200-day moving average, but these are still holding up fairly well. Keeping an eye on this WAG NYC breadth thrust. Now, this is Friday's reading. Let's hope that we see more of an advance here when we finally get Monday's reading for this. We want to get up to this red line. Then the indexes with the S&P, we're positive across all time frames now, according to this. We're still negative with the mid caps in the short and intermediate term, as we are with the small caps, and the NASDAQ 100 is positive across the board on all time frames. Bonds are still negative based on price. Commodities are looking more positive here in the short and intermediate term. So kind of across the board here, but the areas that really helped the market did well. Tech, that was the strongest area. Communication, discretionary. Those are three areas that were up, and that helped the indexes to go higher. An awful lot of green or blue here, but Canada, maybe they don't like the fact that their prime minister is quitting. I mean, that might be a little bit of a negative thing, but a lot of positive things here. First, we had a MACD crossover in Canada. Then the tech sector, BPI, went back above 50. That's encouraging. And then we have the NASDAQ going 18.7, 18.8, 18.9. The S&P got above 6,000. Healthcare, which has just been getting decimated lately, that's more defensive, but it's crossing back above 30. Real estate, another area that's been really weak. It's crossing back above 50 with the BPI. The Dow got above 43,000. Discretionary, BPI crossed above 50. The BPI crossed above 50 with the NASDAQ. I showed the one for the NASDAQ 100, and then we got about 20,000 with the NASDAQ. So, I mean, there's some positive things in here. We just need to see, is it going to be more follow through, or is Monday more of a one-day wonder? People just thought it was magically going to go up, so it did. We need to see more underlying strength here. We ticked down with the equal weight. So we're seeing more of a disconnect between the weighted and equal weighted version of the S&P. We're going back up at the ratio. That means the weighted version is outperforming. The Dow ended up being down, still below its 50-day moving average, neutral with the Elder's Impulse system. This has been one of the stronger areas. The Nasdaq up 1.24% above this pivot point, but still below this other pivot point now, which has just recently been added to the chart. This has been a stronger area as well. The Nasdaq 100 up over 1% above this pivot point, still below this other pivot point, and positive with the Elder's Impulse system for the Qs, but the momentum is still negative, although it is starting to turn up. And been watching this too. We were able to get back above the 20 period moving average with the Qs. That's encouraging. The 50 period moving average held, and this may be providing the support that we're seeing, especially since the mega caps and large caps are doing better. We're bouncing back up here, and now getting back above this moving average is encouraging. Small caps, just chopping along sideways. Yep. And then the Russell 2000 small caps, still below 50 with the RSI, still below the 50-day moving average, closing pretty much at the low for the day. The momentum is improving, but still negative. Neutral with the Elder's Impulse system for the small caps. Mid caps hit this pivot point. It's really weird to see the mid caps be the key for overhead resistance, but that's what we hit in Monday's session and then came back down. And that's when the S&P started to come back down too. And neutral with the Elder's Impulse system for the mid caps. This is encouraging from a broader market perspective. We were able to get back above the 50-day moving average with the Wilshire 5000, even though we closed well off of the high. Also getting above the 50-day moving average again with the total US stock ETF. That's encouraging and another broad market measure. And we were down with the financial sector, but still hanging out not too far below the 50-day moving average. The FANG index, these are the mega caps, doing well, up 1.8%. And this is an area that's really been holding up a lot better. We're still below the shorter term trend line, though. We'll be watching that. And coming down with the staples to tech ratio, that's more positive for the market. Apple was up 0.67%, Amazon up over 1.5%. Microsoft up over 1%, getting back above their 50-day moving average. Google was up 2.65%. Meta was up 4.23%. See, when all these happen, the indexes go up. Tesla barely unchanged, up 0.15%, and Nvidia was up pretty strong. It actually had been trading at an all-time high. I think it closed down off of that, but this is still a really strong looking chart right now. Netflix virtually unchanged, but still above their 50-day moving average. And I've been keeping an eye on this, and I was pointing this out over the weekend. Will this 200-day moving average for the staples sector hold? No, we were down over 1%. So now this isn't a huge deal because staples are more defensive. I was just wondering, because they had been so strong throughout most of 2024, if we see a bit of a bounce coming out of this, maybe that would help the overall index. Well, the index went up and staples went down. So this may end up developing into not much of anything. And the total bond ETF, also watching this. This is a little more important. It was still down, but we're hanging out about at the 200-day moving average. Now, this is kind of a longer term chart. This goes back all the way to 2008 here. So we want to keep an eye on this. We need bond prices to go up, which means interest rates are going down. If interest rates continue to go up, at some point that's really going to impact stocks. Semiconductors looking positive with this chart with the SMH semiconductor ETF and coming up a little bit further out of the rainbow, but now just to the high end of this recent range that we've been seeing. This is a newer chart, the Dow Jones Semiconductor Index, actually breaking out now. And I was trying to point that out over the weekend that that's possible. So far, it looks like it's happening. It was up 2.92%. And that could be positive. But when we look at the SOX index, we're still in a downtrend. Now, we got above the 200-day moving average. So this is improving. If we can continue to go up, that'll eventually turn this into a golden cross. And we're seeing a nice little bounce here with the semis to tech ratio. And this is where the strength came from in Monday's session. Can it continue? We've seen little hopes of, upward thrust here, only to have it then come back down into this sideways range. And a little bit of an improvement, but pretty much neutral now with US versus world stocks, still improving longer term. Oil's continuing to go up, and this might be more for geopolitical reasons here, even though it's still in a downtrend. It's getting up into the 73 range here, even though it was down 0.54%. And the dollar ended up being down, but in after hours, it's back up over the 108 level, and it's still in a solid uptrend, which could pressure stocks. And we continue to go up here with the 10-year yield. We continue to go down with the 10-year based on price. This is another concerning chart, home construction versus 3 to 7 year bonds falling below this support level. And the rainbow is starting to roll over as well. Seeing an improvement here with Qs to S&P, still under the moving average with discretionary to the S&P. Large cap growth turning back up when compared to large cap value. So the large caps, mid caps, and small caps all saw improvements with their growth to value ratios. And we're going down with the staples to S&P ratio. That's more positive. When this is going down, the S&P is going up usually. So what's our outlook for Tuesday? There will be the state funeral for President Carter on Thursday, January 9th. The markets will be closed. The technicals were still short-term negative until we can get above that 20-period simple moving average and close above it. We're still leaning more negative right now, although we are improving. And we're going to get the trade balance and ISM. That's a pretty big one. That'll be coming out in Tuesday's session. We're going to start to get some jobs data this week, too, with the employment situation report coming out on Friday. And then all the crazy geopolitical stuff going on. And here's Tuesday's calendar. And then I don't know what's going to happen with Thursday because that's closed, but it was an unscheduled closure due to the funeral. So I don't know if these are going to come out on Wednesday or if they're going to wait and come out on Friday. I'm not sure what's going to happen there. And then Friday, we're going to get the employment situation report as well as consumer sentiment. So these are big. The ISM non-manufacturing or services, if you want to say it that way. These are pretty influential reports that'll be coming out. And seasonality neutral to positive with the Dow for the 7th of January, where we're flat out positive with the S&P going back over the last 21 years or so. But when you look at the longer term here with the Stock Traders Almanac, we are going into the next few days of this being negative seasonality. We're looking at the green dashed line. This is a post-election year now, or you could say it another way, the first year of a new administration. Then Tuesday is the least positive day based on what happened in 2024, but the first half of January is one of the better performing parts of the year before we get into another okay performing part in the second half of January. Small caps going nowhere. They should be at the moon by now. January is up 58% of the time with a 1.1 return here. And this just takes the different areas. Now we're focused more over here on this side, and we're kind of still at the beginning of this. So it's hard to read a lot into that. The reason I'm showing this is just to give you a look out going over the next year and what different criteria has been used to use this measurement. And the first quarter usually is not all that great when you have a new presidential cycle starting. This also was updated, and I'm going to start putting boxes around this. The January 1st through the 6th, that tends to be positive, and we were in Friday's session. And now through the 7th through the 9th, this is where we hit a little bumpy times before we go back into more positive times. See, we go back and forth. It's like a ping pong match here in January. And then the warning signs that are more negative, we're getting a mixed picture with our smart money indicators. Accumulation distribution is pretty much flatline, slightly positive. Chaikin money flow improving but negative. Chaikin oscillator actually turning down. The advanced decline line, not really seeing an improvement there. The S&P McClellan oscillator and summation, they're both below zero still. Parabolic SAR is negative. The Swenlin trading oscillator, the momentum oscillators are negative. We still have a confirmed Hindenburg-Omen, the vortex. Our moving average studies, not really showing all that much improvement. The ease of movement, the money flow, the ultimate oscillator, and then the momentum for the NASDAQ 100. The positive sign, we're still looking good. Growth to value, discretionary to staples. But that's been that way for a couple of weeks now as the market was really hitting some difficult times there. This has still been holding up, and that is under the surface and could be considered positive. We're going down with the 5 and 10-day equity put call ratio charts, and that's positive. And we're positive with the NYSE McClellan oscillator and summation index, even though we ticked down a little bit on an up day. We're looking better with our bullish percent indexes, and that's encouraging because these are not moving averages, these are not oscillators, these are measured using point and figure buy or sell signals. And the fact that this is going back up is encouraging. And we're still positive with our 200-day moving average study, even though it declined, and the financial sector is still positive there. And then this is kind of strange. We're actually spiking down now with the Hindenburg-Omen indicator. Don't tell the perma bears that because they're pretty much declaring put a fork in it done as far as going down with the market. But this is actually, we still have a little bit more time here to see how this thing works out. So the conclusion, we are improving. And the large caps and growth are still doing quite well. We're still getting a large part of the support from the market from the NASDAQ and NASDAQ 100. We are still negative in the short term, but improving. We're below the simple, but above the exponential 20-period moving averages. Intermediate term, we're back to positive, but the 20-period moving averages are now acting as resistance, and we are still positive in the long term. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.